Welcome to this masterclass on South African residence-based taxation. Look, if you are a BCom, CTA, or tax student, nailing this topic is absolutely non-negotiable. Today, we're going to build a bulletproof framework for your exams. We're going to cut right through all that dense legal jargon and map out exactly how to figure out if a taxpayer is a South African resident or not. Let's get right into it.
We've set up this explainer as a super logical progression. We'll be covering the foundations of tax residency, the ordinary residence test, the physical presence test, the 330-day escape rule, double taxation agreements, and we'll wrap it all up with an exam technique decision tree.
Starting off with Section 1, Foundations of Tax Residency.
So, before we do anything else, we really need to establish exactly why the taxman actually cares where you sleep at night. Well, it basically all comes down to the sheer scale of liability. South Africa operates on a residence-based tax system, meaning if you're classified as a resident, you are taxed on your worldwide income. Literally every single cent you earn anywhere on the planet is potentially taxable in South Africa. But on the flip side, if you're a non-resident, you only pay tax on income sourced from within South African borders. It's a massive difference. And honestly, that's exactly why taxpayers fight tooth and nail to prove their non-residency, and why you absolutely have to know how to test for it.
Moving on to Section 2, the ordinary residence test, which is the subjective approach.
Now, this is the very first hurdle in our decision tree, and it's where you basically get to act as a legal detective. The tricky part? The Income Tax Act doesn't actually define the term ordinarily resident. Instead, we have to lean on historical case law to figure out a taxpayer's true subjective intentions. We're really looking for the place they consider their true home, the base they naturally return to after their travels or overseas work gigs.
And that brings us to the exact precedent you're going to need to cite in your exams. First, you use the landmark Cohen v. CIR case to establish the principle of a person's real home, the place they naturally return to from their wanderings. Then, you use CIR v. Cuddle to analyze their broader life choices. And here is a crucial tip for your exam technique. Just because someone is physically absent for a whole year doesn't automatically mean they aren't ordinarily resident. You really have to look at their intention and their mode of life well outside just the specific year of assessment you're reviewing.
But there is a catch. If the facts in your scenario show that a person formally emigrates with the clear stated intention of never returning to live in South Africa, well, their ordinary residency just snaps off immediately. It literally ceases the exact day they board the aircraft to leave the country. They're a resident right up until the day before, and a non-resident from the second they fly out.
Right, let's jump to Section 3, the physical presence test, which is the objective approach.
So, if the taxpayer is not ordinarily resident, say they're a foreigner working in South Africa, we throw out the subjective detective work entirely and put on our mathematician hats. This is the physical presence test, or PPT for short. It's a rigid, three-pronged formula. To be deemed a resident here, every single step you see has to be met. They need more than 91 days in the current year, and more than 91 days in each of the previous 5 years, and more than 915 days in total across those previous 5 years. Fail even one condition, not a resident under this test. Oh, and golden rule, part of a day totally counts as a full day. I want you to really notice this massive 915-day threshold over 5 years. It's built in specifically to make sure someone doesn't accidentally become a South African tax resident just because they took a few long holidays or popped down for a quick consulting gig. You literally have to spend a substantial cumulative amount of time in the country over a prolonged period to actually trip this wire.
But watch out, because here is a massive trap for students. Please be incredibly careful with this in your exams. If all the requirements of the physical presence test are met, the residency doesn't just start on the 92nd day. Nope, it retroactively kicks in from the very start of that relevant year of assessment. Examiners absolutely love using this timing trick to see if you truly understand how these objective rules apply.
Move into Section 4, the plot twists, featuring the 330-day rule and DTAs. Okay, so you've tested for ordinary residents, you've done the physical presence math, and you think you have your answer. Well, not so fast. Let's look at the 330-day escape rule. This applies to someone who's a resident purely because of the physical presence test. If they leave South Africa, a clock starts ticking the day after they physically depart. If they maintain a continuous absence for at least 330 full days, something crazy happens. The law actually reaches back in time, and they cease to be a resident from the very day they left. It totally nullifies their residency from the moment they cross the border.
And that actually leads us to an even bigger exception. Think about this. What happens if South Africa says you're a resident based on our domestic laws, but another country looks at their laws and claims you too? It's a dual residency conflict, and honestly, it happens all the time in international business.
Enter the ultimate trump card. If there is a double tax agreement, a DTA, between South Africa and that other country, it's going to have these things called tiebreaker rules. If those rules decide that you belong exclusively to the other country, your South African residency is instantly voided. Boom, gone. You are carved right out of the resident definition in the Income Tax Act, completely regardless of your ordinary residence or physical presence.
Just real quick, let's touch on non-natural persons, so your companies and trusts. Obviously, you're not tracking wanderings or counting up 915 days for a corporation, right? For them, the test is super simple. It's where they are incorporated or established. If they aren't incorporated in SA, they could still be residents if their place of effective management, or POEM, is located here. Basically, you're looking for where the actual day-to-day commercial and management decisions are made in substance, not just where a board meets on paper. And yep, just like individuals, companies can also use those DTA exclusions.
All right, Section 5, Exam Technique and Synthesis. Knowing all these facts is great, but synthesizing them into a cohesive argument, that is what actually gets you the marks. So, when you open your exam paper and spot a residency question, don't panic. Just follow this exact decision tree, step by step. Step 1, always start with subjective intention, the ordinary resident test, and make sure you psychoan and cuddle. Step 2, only if they are not ordinarily resident do you move to the objective math of the physical presence test. Step 3, if the PPT says they're a resident, immediately check if that 330-day continuous absence rule gives them an escape. And finally, Step 4, always check the scenario for any mention of a foreign country and a double taxation agreement to finalize their status. Stick to that exact flow, and I promise you, you won't miss a mark.
As global mobility shifts and remote work basically becomes the new normal, defining a person's real home is getting wildly complex. People are crossing borders way faster than these tax laws were originally designed for. So take the time to master these rules, practice those timelines, and get your case law memorized. Because whether you're sitting in an exam hall or doing real-world tax consulting, the taxman is definitely paying attention.